On Wednesday, April 22nd, Tesla reports earnings, and within 60 minutes of that call ending, the stock will move 6, 8, maybe 12%. Billions of dollars, created or destroyed, in 1 hour. Every analyst on Wall Street is arguing about whether EPS comes in at 39 cents or 42 cents. We built a model, backtested it against every quarter of 2025, ran 8 earnings call transcripts through natural language processing, dug into a $2.9 billion equipment deal that broke 3 weeks ago, and found something nobody is talking about. The EPS doesn't matter. This video will show you what does. We built a bottom-up earnings model. Deliveries times ASP gives us auto revenue. Energy deployed times revenue per gigawatt hour gives us energy. Layer in reg credits, leasing, services, then estimate margins, operating expenses, taxes. Before we used it on Q1 2026, we backtested it against all 4 quarters of 2025 to see if it actually works. Revenue accuracy, outstanding. Average error of just 1.9% across all 4 quarters. Excluding one product launch quarter where pricing shifted, the error was 0.5%. The framework works. But we also found 5 systematic biases. We consistently underestimate auto gross margin by about 95 basis points. Tesla cuts costs faster than anyone models. We underestimate R&D spending by 6.5%, and our GAAP earnings estimate runs about 10 cents too high because Tesla's effective tax rate, stock comp, and below-the-line items are noisier than our simple formula captures. We corrected for every one of those biases before estimating Q1, and after all that work, the answer surprised us. Stay with me. Here's our bias-adjusted estimate for Q1. 41 cents adjusted EPS, Wall Street consensus, 39 to 40 cents, and the whisper number, the unofficial buy-side expectation that institutional traders actually trade against, is 38 cents. That's a 3-cent spread. On a $250 stock, 3 cents of EPS is noise. It is not going to move the stock. What's interesting is the whisper is below consensus. That means institutional traders actually expect Tesla to miss the published number, and 89% of retail is positioned long. When the buy side is skeptical and retail is crowded on one side, that's a contrarian setup worth paying attention to. Tesla's beat and miss pattern over the last 8 quarters is 5 and 3, close to a coin flip. The EPS number is not where the alpha is, so if EPS doesn't matter, what does? 4 things: auto gross margin, a $4 billion hidden revenue pile, the capex iceberg, and the earnings call itself. Let's break each one down. The one financial number that actually matters Wednesday night is auto gross margin, not EPS, not revenue, auto gross margin. And here's the part nobody else is telling you. There are 2 hidden forces fighting inside the margin number this quarter. Force 1, Tesla ran its most aggressive promotional quarter ever. 0% APR for 72 months, inventory discounts of $1,500 to $3,000 per vehicle, FSD bundle deals, China financing subsidies. We estimate roughly $1 billion in total promotional cost. That's a 4 percentage point drag on gross margin. Force 2, working in the opposite direction. Q1 2026 is the first full quarter of Model Y Juniper-only production. No more transition costs, no more mixed lines, clean production with the new structural battery pack, simplified wiring harness, and about 20% fewer parts. We estimate $1,200 to $1,800 per vehicle in cost savings. The street is modeling the promotional drag without accounting for the Juniper offset. That's why we think auto gross margin could surprise to the upside. If it prints above 18%, the street has to raise full year estimates. If it prints below 16, the Q4 beat was a mirage. One more thing on the financial side before we get to the big story. FSD subscriptions. Many of you already know Tesla has $3.8 billion in deferred FSD revenue sitting on the balance sheet. What matters for Q1 is the transition. February 14th was the last day to buy FSD outright for $8,000. There was likely a rush of purchases that gives Q1 a one-time bump. After that, it went subscription only at $99 a month. Subscription revenue gets recognized immediately, no deferral, which is cleaner for the income statement going forward. The number to watch? FSD subscribers went from 1.1 million in Q4 to what in Q1? And are they paying $99 or $49? The discounted rate for enhanced autopilot owners. That mix matters. Now, the much bigger story, the one that could move the stock 8 to 12%, is the capex iceberg. Tesla guided $20 billion in capex for 2026. That sounds like a lot, but it's actually a floor, not a ceiling. On the Q4 call, the CFO said, and this is a direct quote, "None of these numbers factor in anything to do with the solar fab or the semiconductor chip fab." Terafab, Tesla's semiconductor factory, started construction in Austin on March 21st. Intel joined as a partner on April 7th. The pilot facility alone is estimated at $20 to $25 billion. Even the 2026 portion could add $3 to $5 billion on top of the guided 20. Then on March 20th, just 3 weeks ago, Reuters broke that Tesla is in talks to buy $2.9 billion in Chinese solar manufacturing equipment from Suzhou Maxwell and 2 other Chinese suppliers. Equipment shipping to Texas by autumn. That was not communicated on the Q4 call. That's new spend the market hasn't fully priced in. And then there's Cybercab. As we covered in our deep dive video last week, Cybercab started pilot production in March. Over 200 have rolled off the line, but we don't expect consumer sales this year. They're all going to Tesla's own Robotaxi fleet. That means they're a pure cost center, production costs with zero auto revenue. Now look at what happened to every other big tech company that raised AI capex this earnings season. Microsoft, guided $150 billion annualized, stock dropped 10%. $357 billion of market cap wiped in one day. Alphabet, $175 to $185 billion, down 7%. Amazon, $200 billion, down 8 to 10%. The only exception was Meta, up 10%, because they showed 24% revenue growth to justify the spend. But here's the nuance most analysts will miss, and this might be the most important thing in this video. If the capex number comes in higher than $20 billion, ask yourself, why is Elon spending faster? He built Giga Shanghai in 10 months, Giga Texas in 18 months, and XI's Colossus supercomputer in Memphis. They were told it would take 24 months. He did it in 122 days, 4 months. If Elon is accelerating terafab spending, it's not because he's careless with capital, it's because he's confident that Optimus and Cybercab will scale fast enough to need those chips. The speed of the spend tells you more about his conviction than anything he says on the call. So the question for Wednesday isn't just how much is the capex, it's how does Elon frame it. If he says we're accelerating because demand is pulling us forward, that's the Meta playbook. Stock goes up. If he says we need to invest for the long-term future, that's the Microsoft playbook. Stock goes down, same dollars, completely different market reaction based on framing. And that brings us to the tool we built specifically for reading the call in real time. We built an earnings call tone analyzer. We ran every Tesla earnings call transcript from Q1 2024 through Q4 2025, 8 quarters, through natural language processing. We measured hedging words versus confidence words. We call it the hedge to confidence ratio, or HCR. In the 5 quarters where Tesla stock went up after earnings, the average HCR was 0.74. Management was confident. In the 3 quarters where the stock went down, the average HCR was 1.81, more than double. The strongest example, Q2 2025. Elon used probably twice in one sentence about Robotaxi expansion, subject to regulatory approval. BYD is a formidable competitor. The HCR was 3.3. The stock dropped 8%. The opposite, Q3 2024. Record deliveries. I have never been more optimistic. The HCR was 0.4. The stock rallied 22%. Here's the counterintuitive finding. Q4 2025 had a very bullish tone, HCR of 0.38, but the stock still dropped 3.5% because the $20 billion capex guidance spooked the market. Tone alone doesn't save you. It has to be backed by substance. Which brings us to the substance Elon needs to deliver on Wednesday. Here are the 3 things that will move the stock more than EPS. Number 1. FY 2026 guidance. Will they raise, maintain, or cut the delivery and capex outlook? After a weak Q1, maintaining guidance signals confidence, and if capex goes above $25 billion with terafab included, watch the framing. Number 2. Robotaxi and Cybercab expansion. This is what the $250 plus valuation is priced on. And here's what's happening on the ground right now. 60 Robotaxi-equipped Model Ys with camera washers have been spotted staged in Phoenix. Similar sightings confirmed in Las Vegas and Dallas. Camera washer hardware upgraded across all cameras. This is operational readiness, not testing. Now think about this. Tesla had a 50,000 vehicle inventory build in Q1. Everyone is calling this a demand problem. But what if a meaningful portion of those vehicles are Robotaxi fleet cars being staged across these cities for the multi-city expansion Elon promised would hit by June? That completely reframes the inventory narrative from demand weakness to strategic deployment. If Elon confirms this with specific city launch dates, that's the single biggest catalyst Wednesday night. Number 3, capex framing, Meta playbook versus Microsoft playbook. But there's one more factor nobody else is talking about. SpaceX filed its S1 with the SEC on April 1st. The roadshow starts the week of June 8th. They're targeting a $75 billion raise at a $1.75 trillion valuation, the largest IPO in history. This Tesla earnings call on April 22nd is the last major Tesla event before the SpaceX roadshow begins, 47 days apart. Does Elon want Tesla shareholders? The very same retail investors SpaceX is explicitly courting for the IPO, feeling good or bad going into June. SpaceX CFO said retail will be a bigger part of this than any IPO in history. This creates incentive for Elon to pull a rabbit out of his hat on Wednesday. Specific Robotaxi city announcements. An Optimus V3 unveil date. Intel terafab cost-sharing details. But Elon has overpromised on timelines before. And there's an even wilder scenario. What if Elon wants Tesla stock down? SpaceX at $1.75 trillion could theoretically acquire Tesla. Consolidate AI, robotics, energy, and space under one roof. Too many unknowns to bet directionally. The value isn't in predicting which way, it's in knowing what to listen for. So here's your real-time framework for Wednesday night. While you're listening to the call, count the hedge words. Probably, challenging, cautious, difficult, subject to. Count the confidence words. Record, confident, definitely, on track, transformative. If confidence is dominating, Elon is specific, giving numbers, giving dates, that's an HCR below 1. Historically bullish. If hedging is dominating, vague timelines, acknowledging competitors, walking back prior promises, that's an HCR above 1.5. Historically bearish. We'll be running our tone analyzer live during the call and posting real-time HCR scores on X. Follow us to see the scoring as the call happens. That's part 1. The model, the EPS non-event, the hidden margin battle, the capex iceberg, the tone analyzer, the Robotaxi wildcard, and the SpaceX factor. In part 2, dropping Monday before earnings, we'll cover the top shareholder questions from say.com, the institutional flow positioning, where the stock is trading going in, because a rally into earnings means a harder fall if the call disappoints, and our scenario analysis. Subscribe so you don't miss it. Follow at Entonic Stock Pick on X, Trade Alerts AI on YouTube, and Trade Alerts AI 777 on TikTok. Not financial advice. See you before Wednesday.